Market investing is really like no other discipline because the whole world is telling you no, no, no. And you're saying, well, maybe yes. You're swimming against the tide in like no other industry because it's the judgment of millions of people and all their decisions on a stock. But that forces me to have discipline.
We aren't going to be changing human nature anytime soon. You got to just stick with the model.
The stocks don't know you own them, and even if they did know, they still wouldn't care. I wanted to show investors, you don't have to do anything fancy. You don't have to trade. You don't have to do any of this.
You're transparent. Everything is on the list. You hold for a year, and then you give yourself the option of replacing 5 names.
I'm lazy as you can be. That's it. That's my secret.
Well, hello, everyone. It's Jim O'Shaughnessy with yet another Infinite Loops. Today's guest has been a very, very good sport to me over on Twitter. I don't think I'm ever going to call it X. Are you, Eddie?
No, it's always Twitter.
So my guest today is Eddy Elfenbein, who is the proprietor of one of the OG blogs on Wall Street and investing called Crossing Wall Street. His buy list is a thing of legends. We're going to talk about that, and we're going to talk about a lot more. But so much so that it actually led to an ETF called Advisor Shares Focus Equity, ticker CWS. And I noticed I haven't been over on Morningstar forever, but you have 5 stars. Eddie, welcome.
Thank you very much. And I just want to say, for years, I've been a big fan of yours, and it teased you that you had a giant social media team, but I know you don't. You're a brilliant tweeter, and funny, and it is impossible to go to a meme war and emerge victorious. No, many have tried. So I just want to tell you that, and also you have such a wonderful team at O'Shaughnessy Asset Management. So I thank you. It's a great honor to be here.
Oh, it's a great honor for me to have you, Eddie, because you also are an incredibly good sport. And, generally speaking, I've been following you for years, and you just really are a good sport about everything. You got some great quotes. I think if I'm remembering correctly, your pinned tweet is along the lines of, a bubble is a bull market in which you have no position. Am I getting that right?
Yeah.
So let's go origin story. As I mentioned in the intro, you literally were one of the first financial bloggers. I think you and my buddy Barry Rinholtz were the only people blogging, and I know that the traditional mainstream financial media didn't. I think there's a great story where they had you on TV in the early days, and I think, as you put it, they sat you at the kids' table. Tell us about that.
Barry was the first person I read a lot that was blogging, and so I jumped in after he did. And at that time, the media, they just did not know what to do with us. And I remember I was invited on CNBC, and I mean, they just didn't even know what it was. And I remember the woman said, "So what are your bloggers saying?" And she said, not like the people reading it are called bloggers, not. And that even took a while. And I remember I had this very, complicated, I was going to say, well, the Federal Reserve right now is, and they just want to, so what are you guys, what are the bloggers talking about? And I wanted to go on and discuss markets at a sophisticated level. And it was just I remember shortly afterwards, then all of the financial media sites had their blogs. But I remember they were saying, well, what if somebody put something up on a blog that isn't correct on the media or somebody? And I was trying to say that it's a whole network of people, so somebody can come back and then comment on that. So it's not just one post that just goes into the ether. But this was it was lost on them. It took them a while to pick up what was really going on.
So I used to do quite a bit of financial media, CNBC especially. And but what was it, Eddy, that drew you to that brilliant, as it turns out, decision to be the first to kind of plant your flag on the blogging side of the ledger? And was it a prescience? Was it being online early? What was it that got you there?
I think what I'd seen that blogging had taken off, talking about a lot of the events after in and around 9/11, and a lot of people talking about national security and politics, and then it got into finance. And I remember thinking, look, I have something to say, and I can't go through the traditional gatekeepers. So maybe I can start my own blog, and I can discuss things in depth that I think are interesting. I remember early on, there was a story the Wall Street Journal did about how executives were backdating stock options to their benefit. And I remember they played it out as it was this obvious theft that they were doing. And they said they were benefiting off 9/11. And I thought that was extremely unfair, the way they presented that article. And it was the kind of issue where I had to sit down and lay out my argument in several paragraphs, why I thought their reporting on this was very poor. I couldn't just shout it at somebody. I needed to take my space and lay out the argument. And that's what blogging allowed me to do. And where I would have had, if I wrote a letter to the editor or something like this, I had no other way of reaching people. And then when you sit as something interesting in a blog, and then it gets passed on to somebody, and they pass on to somebody else, and then it can, become a larger and more broadly read.
Yeah, I think that there's still kind of all media. Let's not just single out financial media, but I think they're still kind of in a tantrum about the ability that people are able to make reasoned, incredibly good arguments via a blog, and they can't stop anyone from reading them.
Right.
And also the interactive nature of both social media and blogs, where your readers can start a conversation with you. It's sort of peer-to-peer as opposed to one-to-many. You were much earlier than me, though. I didn't figure that out. I'm much slower than you, obviously. I didn't figure out the fact that I really needed to be on social media until about 2015. I had an early Twitter account. I think I joined in 2009 or 10. But honestly, the first time I went on Twitter and I was looking at it, and now this is circa 2009, right?
Right.
And I had a lot of young people working for me at OSAM at the time, and I called some of them in. And I'm like, explain this to me. This guy is he's talking about his lunch, and
right.
How is this going to be this great financial network? I wised up and pretty much moved exclusively to social. Do you think that the tenor and spirit of conversation, et cetera, is still what it once was, or are we out of that golden age?
I think we probably are out of that golden age. And I can just say, for me personally, the blog has faded in use. I do some news updates, and I post my free newsletter on my blog, and I have my active buy list page. But in many ways, Twitter has swallowed that. And also for me, Substack has swallowed that as well. And that is where it's easier for me to focus on. And those have come at the expense of just my traditional WordPress blogging site.
So do you think that the other thing, if you, because you're like me, you've been around for a bit. Do you remember back in the day in the early 2000s where literally you couldn't have a blog or Twitter handle if you were in asset management, and the switch from that absolutely not, thus all of the anonymous people on financial Twitter at that time, and then fast forward, I don't know, 10 years, and it was if you are not on financial Twitter, like, who are you?
Mhm. I think the real turning point was when the journalists came on and they said, okay, this actually, you got to be on. And somebody like Joe Weisenthal, early on, really understanding that. And then, they're following people who maybe weren't journalists. So like myself and others. Once that happened, I think things the thing about financial Twitter, for all the complaints about it, it's a very good way to disseminate live information, something that's going on in the market right at that time. It's an excellent place to do that for all of the criticisms of finance Twitter, which there are many, and many are well reasoned. But just getting information out there, it's hard to beat it.
Yeah, I kind of developed a thesis that Twitter, is anti-fragile, right? Like,
Mhm.
how many times have they announced the death of Twitter, especially after Elon took it over?
Mhm.
And it just continues to zoom along. And I kind of thought, and jury's obviously still out on this, but that Twitter really could emerge as the first worldwide global intelligence network. But you needed to do a lot of curating, a lot of pruning, etc. Do you follow people like with whom you just absolutely disagree on markets just to see what they're saying?
I can't really not to do it, to hear what they say. A lot of it is a lot of what I like about finance Twitter is I can have those voices go away. I don't have to listen to them. Of course, you don't want to create a bubble, but I just mean people are kind of obnoxious, and Twitter's unfortunately anything within finance. It's easy to get an audience just to be obnoxious and contrarian and just angry. You can build very quickly an audience, but that's what I'm not terribly interested to listening to those voices.
Yeah, and I think you, like me, are looking for things to root for as opposed to against. And that kind of leads me to your buy list, which is really fascinating. When I was going through it again, I was reminiscing about, I actually put in my book, What Works on Wall Street. There was a fund which changed owners many, many times. I think it's currently called the Voya Corporate Leaders Fund, that started back in like 1935. But the idea was somewhat similar to yours, because your buy list is now 25 names. It started at 20, right?
Like, that's right.
But you hold yourself to, one of the things I love about it is you're transparent. Everything is on the list. You hold for a year, and then you give yourself the option of replacing 5 names. Am I still getting that right?
That's correct. Yep.
And so basically, it's kind of, I always joke about how lazy I am, and how I was, one of the aspects of being able to succeed in asset management was my natural laziness. But what gave you that idea? Was it just a belief in buy and hold investing? What gave you the 5-year holding period? Tell us about the list.
I wanted to show people that it could be done to have a buy list. The actual years ago, Louis Rukeyser would have his guests, his regular guests, I think you call them the elves, and they would do at the beginning of the year select. I don't think it was a particular number of stocks, but that's how they had their contest each year. So it was sort of loosely based off that, and so I said when I started the blog, I think the first year of the buy list was 2006. So we're coming. This is its 19th year of the buy list. So I chose 20 names, and I wanted to show investors you don't have to do anything fancy. You don't have to trade. You don't have to do any of this. Let's just buy and hold and watch these 20 names and see how well they do. And so that's sort of what the buy list was about. That was the idea I wanted to get across. And the reason I did 5 was I felt that means the average holding period is now, with 25 stocks, is 5 years. And that, I think, is sort of the length of a market cycle. That's I think a reasonable enough time to judge Has this been a good investment? Has this been a bad investment? Some people think it as a hindrance, but I see it as a benefit because when I make these changes to my buy list, I have to sit down and say, am I comfortable holding Hershey or Aflac for the next 5 years on average? Once you think that way, it really changes the way you look at a company and what you want from the company. So a lot of things, I have no idea what some companies are going to be like in 5 years, if they're going to exist or not. With Hershey, I think I have a pretty good idea what it's going to look like. With FICO, I think I have a good idea. So in many ways, I see it as a benefit of getting that 5 years. So I'll just say when we started the ETF, the buy list became an ETF, we bumped up against some of the weighting regulations of the SEC. So just by increasing it from 20 stocks to 25 really made those concerns go away. So it was kind of a small change, but helped us out. Once we became an actual legal trading vehicles, then there's a different set of rules you have to play by. So,
and has the way you create the list changed in any material way since you started it?
Nope.
So just sticking with your knitting.
Yep. I have what I call a watch list of about 80 to 100 names. I can't say I know everything about the company, but I'm vaguely familiar with those companies. And those are sort of like the minor leagues of the buy list as the majors. And I look who looks cheap, who's been doing well, who's ready for promotion to the big leagues. And so it's companies I've been looking for a while. And maybe one of the downsides is I'm looking, particularly in December, looking for stocks that are a bargain. By the way, I'll just say this, if this is a good lesson to investors. A lot of times when a stock is added to the buy list, its best year is like its third year on the buy list. That happens a lot. You put on a stock and maybe it's up 5%, it's up 12%, and then the third year it's up 41%. I mean, that happens so frequently. Peter Lynch says that sometimes the best stock to own is best stock to buy is the one you already own. And that happens a lot. Sometimes maybe my analysis, we're just a little early. It takes a little time, but that third or fourth year, you really get the home run gains.
Yeah. And, one of the things that I find interesting, I believe that there are many paths to stock market success. Mine was through quantitative investing. But as I was looking at your stuff, and I think one of the other benefits of a quant isn't just provided to quants, but one that's a general benefit, and that is discipline, right? Like when you're a quant, you might lack that internal fortitude. Well, then being a quant is very helpful, right? Because you gotta just stick with the model. How do you avoid? Because really, your discipline is legendary. How do you avoid second guessing? How do you avoid all of the, holy shit, maybe I really fucked up here?
Well, the thing is, I don't avoid those. I'm always second guessing. Always. Market investing is really like no other discipline because the whole world is telling you no, 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 and you're saying, well, maybe yes. You're swimming against the tide in like no other industry. Are you doing this because it's the judgment of millions of people and all their decisions on a stock, and you say, nope, you're wrong. But I always am second guessing myself. The benefit again, I think of just saying December 31st, we're going to change the stocks. That is putting a completely artificial straitjacket on, but that forces me to have discipline. So I get scared. A company I like a lot, SAIC, they're down a lot today. They had an earnings report. It felt just a bit short of expectations. And I'm sure there's lots of people, no, we're just selling it. And I would be tempted too, but nope, I'm going to hold on to it. And fortunately, the rules of the buy list and the ETF dictate that we can't do anything until December. But I know human nature, absolutely, I would want to run and sell or pick up the hottest thing. That's just how markets works. And as you know, the data clearly shows that, it's always the market's going from one extreme to another. Market is made up of people. That's one of the problems about quantitative things is you're trying to add numbers. You're trying to distill something that is at root is just highly emotional, and it's a very human entity. So I get nervous, afraid, second guess myself. It happens all the time.
Yeah, I've long said that the four horsemen of the apocalypse are fear, greed, hope, and ignorance, and that we aren't going to be changing human nature anytime soon. Markets change.
It sounds like a law firm.
I love that. I'm going to definitely steal that. That's going to be a full quote. But essentially, markets change millisecond by millisecond. Human nature barely budges millennia by millennia. I think the last sustainable edge in public markets, at least, is arbitraging human nature. And one of the things that, they might look very different, your process versus, say, a quantitative process, they are a process, right? And I've always thought that people who had a process that they believed in, that they, in many circumstances, especially on the pro side, of course, but even for retail individual investors, is a process that they've done some time looking into, that they've done some homework on. And I think that's important because they got to be able to stick with it, right? A process isn't going to do you any good if you're jumping around all the time. But you've written a couple of things that I want to talk about too, because I just think that some of your insights are great. Deep truths about investing and the Elfenbein theory to explain the entire stock market. I love the modesty of that. That's where you and I get along totally well. Why don't we start with some deep truths about investing that you wrote about? I think it was a while back, but I think there's still true. When I went through the list, I was like, yep. Give us a couple.
Well, I was a fan of Bill James, who writes about baseball statistics, and he said, he once sort of said, after 20 years of looking at baseball statistics, I want to take a step back and list what he called the deep truths and so I was taken by that phrase, the deep truths. So I tried to take it on to finance, and I think I had 44 of them. And by the way, Morgan Housel, he advised me to turn that into a book, and that was before all the success that he's had. So I should have taken him up on his advice back then, but I did not. So mistake on my part.
Well, but we do have at O'Shaughnessy Ventures, we do have a infinite books division. So if you want to rethink Morgan's advice, funny story about Morgan, before he became, the saint to financial investors everywhere that he was, I knew Morgan way back in the day, and actually tried to hire him. And he had the incredibly intuitive good sense to turn me down. But I think that would be a great book. Okay, Eddy, give us some of the pearls of wisdom, the great truths about investing.
Oh, I don't have them in front of me. I'll think of a good one. I don't know if I specifically said this, but one I think is an important truth is that they say bull markets go up by the stairs, bear markets jump out the window, and that's very, very true. The bull markets tend to be long, not terribly interesting markets. Also, since the bear markets are so sharp, the bull markets climb unusually fast, and that unnerves people. Usually, the bear markets, the problem isn't right at the top, but historically, it's a slide, an ugly slide before the big drop. Again, these are generalities, but you find that again and again within the markets. Another one is about looking at the balance sheet. And I want to be careful how I say this because there are obvious exceptions. But usually companies don't get into problems because of the balance sheet. Rather, the balance sheet becomes a problem because the company is trying to cover up issues within its operations. The operations is always really the ground floor where you want to look, and the balance sheet follows that. There are obvious exceptions to that, but nothing can really, if you want the balance sheet to improve, once operations improve, that's going to help things a lot. And once operations start going bad, it's difficult to turn around, and you're going to start to see those cracks and fissures show up on the balance sheet. So it's sort of which comes first, and it's usually you want to see, are the operations, are they are they selling, are they, is inventory backing up? Those are the things that you want to look at. Do you have any recent?
We actually build a lot of those into at my former firm. You know that I'm no longer at O'Shaughnessy Asset Management because the great folks at Franklin Templeton are running things over there now, and I think doing a great job of it. But we when I was still there, we built a lot of those checks on the balance sheet into the quantitative models that we used just to check for what you just said. You had a couple more that I really loved. This one I love in particular. Stocks don't know you own them.
Yes.
Yeah. What do you think?
I mean, you can hear I hear, stocks are taking a breather right now. Or, this rally has legs. It wants to go higher. There's no such thing as the market. There's just people. The stocks don't know you own them, and even if they did know, they still wouldn't care. Stocks, nor are stocks lottery tickets. It's an actual legal. It's an asset it's holding of a company. But people don't. I've also noticed what used to work at the Money Show years ago. People would come up and they call the stocks by the ticker symbol. What do you think of NNVA? They don't even think of it as a company. So that's something I've learned, that there's nothing emotional about it, or people, they'll get angry at the company and say, okay, I'm selling it. It just doesn't work that way. It's very, very unemotional.
Yeah, that's the other place where we're simpatico. I definitely found that being removed from emotions helped me considerably over some pretty interesting markets. When right after the great financial crisis, a guy who had been covering quants for Lehman, which became Barclays, came out and chatted with us, and he basically told us that more than 60% of the quants that he covered had overridden their models, read emotionally, during the great financial crisis. And yet I didn't see any of that from you at all. Like, is it just that you have ice water in your veins, or what? Is there some kind of trick that you could share with our listeners and viewers?
I'm lazy as you can be. That's it. That's my secret.
That is both of our superpowers, Eddy. I think that definitely it helps to have a little benign neglect.
And I charge $20,000 to attend my boot camp where I tell you this. I'm just really lazy.
So what do you do at your boot camp? How long is it, and how do I sign up?
I'm there just one day. The rest, it's like 9 weeks or something.
So a lot of people think, when Robinhood came on the scene, oh my God, they're just gamifying it and turning it into a casino. I happen to hold that opinion about that particular app. But what do you think about the idea that investing has become? I mean, with all the meme stock guys, and they've made a movie about it. Do you think that people are, or more people, I should say, because we both know about the bucket shops that Jesse Livermore started his career more than 100 years ago in. Mm-hmm. For those who don't know what a bucket shop is, in the old days of Wall Street, you could go and basically trade pretend stocks, right? They did follow the actual name up and down, but these were basically off street betting shops, and they called them bucket shops.
Unregulated.
Yeah, completely unregulated. But now, do you think, with all of the proliferation of instant trading, all that kind of stuff, do you think that many people are really just gambling as opposed to doing any kind of real investing?
The answer is yes, but it's always been that way, and it doesn't bother me whatsoever. And this is one of the things I've noticed about financial media, financial commentary, is so often it's a thinly veiled public moralizing. Oh, isn't it terrible that people are investing in Bitcoin? Isn't it just awful? So what? Where's the danger? They always say it's dangerous. Well, they'll lose their money. There's no big danger in that. Nobody's dying. Nobody's going to war or anything like this. Amazon plunged, I think, 96% from its high. Okay, so it goes back up. What I don't like is when people say, "Is this dangerous? Is it gambling?" Yeah, sure. The people, a lot of young people, they get money, they make dumb decisions. As you pointed out, things are probably a lot safer these days than they have been historically, with all the crazy stuff that was going on in the older market years. So are they gambling? Sure. I don't see the harm in it. They can go to Vegas and gamble as well. They gamble for real.
That reminds me of the old maxim that if you don't know yourself, Wall Street is a very expensive place to find out. Another one of the things that you and I agree on is, and you had it in your Deep Truths, was don't invest based on demographics. And being an old hand at this, you're very well aware that there was a certain someone who got very famous writing books about this, and then tried to put it into practice like you, and unlike you, didn't have such a great time. But I'm not going to single him up, because there are a lot of people following demographics, and I remember I read all those books and I was sort of intrigued by the theory, so I tried to follow along. And then I just kind of thought, I understand why this would be a thing to look at, but and I kind of left it there, right? But then I noticed afterwards the revisions to some of these books, and it was like, no, wait. That I didn't mean the market was going to go down. I forgot about the NASDAQ. I was talking about, and it's like the old joke I used to have at my first company, O'Shaughnessy Capital Management, when one of our smaller cap and mid cap strategies was not doing well. We would joke internally that we should maybe try to compare it to the Smussel as opposed to the Russell.
Right. I mean, demographics, of course, it's an important thing as far as like geostrategic things. I know people looked at like the Soviet Union. If you looked at in the 1970s, it was really crumbling. This was kind of under the surface. You can see this. They had tanks, they had jets, they had planes. We saw all that. But really, if you looked at the country, it was becoming a very, very weak country. So of course, demographics are very important in that sense. But as far as the stock market and financial decisions, I just don't see the importance that it plays, or particularly saying that, we have an aging population, so you should buy this. Well, yeah, we have an aging population, but that means lots of things can be bought. It doesn't necessarily come to you. I mean, look at, I think of one of the biggest success stories on Wall Street over the past few decades is Colgate-Palmolive. It's been a massive winner for decades. Any demographics about that? Not that I can see. Or people will try to, paste on a story like Disney and it's the children. Business all business is about satisfying a need. That's all you have to do. It's a lot more complicated and it's a lot less complicated than you think. Just find out, where there's a problem is, customers need something, and fill that need. That's what business is all about.
Yeah, for the fourth edition of What Works on Wall Street, we also looked at the various sectors. And lo and behold, over more than 50 years, one of the best performing sectors was consumer staples. And,
Tobacco.
and tobacco. Like we used to have at my first firm, again, we were younger than it, so we fucked around a lot more. But we had the joke portfolio, which was the opposite of ESG investing. We called it the Eat, Drink, and Be Merry for Tomorrow You Die portfolio. and we had pharmaceuticals, tobacco makers, gun manufacturers. That thing rocked and rolled.
Well, I should have to say that Advisor Share is a wonderful business partner I have. That they do all the running of CWS. They have the largest cannabis fund, MSOS, but they have two other funds I love. One is Vice, VICE, and the other is YOLO, YOLO. I think those are the best ticker symbols you can get.
That's really funny. But, again, it speaks to the point you just made. Companies that are providing people with solutions to their needs or their desires and doing it well, guess what? You make a lot of money doing that, providing people with what they need or want. Another thing that you go after, that I too have gone after in the past, is the whole notion of academic finance. Now, as a quant, I have great respect for the people who did a lot of the long-term studies like Obama, French, et cetera.
Right.
But some of the conclusions I differed rather dramatically with them on, which led to things like the capital asset pricing model, modern portfolio theory. I tend to take the Mandelbrot, the misbehavior of markets point of view, which is wrong. What do you think?
I agree with you. And in particular, the one, for example, okay, value outperforms, but it can go for years with underperforming. So when you talk about these things, we're talking about, 15 years can be a very large portion of a person's retirement years. And where's the value premium? The one I'm particularly skeptical about is the small cap premium. I don't see any obvious reason why it should exist. I can understand why a value reason could exist, value premium, but small cap, I've been unpersuaded by it. My mind is open to the facts. I understand that historically there's been showing very substantial outperformance, particularly by microcaps as well. But as far, I think that could be a hangover from the older style markets. I don't know. I haven't been fully convinced on that.
If my memory serves me correctly, a fellow by the name of Bance wrote about the small cap phenomenon in 1985 in the Journal of Portfolio Management. And I was intrigued by that. And so I did a deep dive. And then obviously for What Works, we did look at market cap as one of the factors. And what the problem with the huge spread that early researchers...
all in January?
Well, actually, it was more a problem with the data sets.
That's what I thought.
Academics, and that's why I felt like as a practitioner, I couldn't run tests the way that academics ran them because I'm a practitioner. And what the academics did that led to that really big delta in the academic literature on the small cap effect was they invested in the decile of stocks on their list that were the smallest, right? Well, the problem with that was they had virtually no liquidity. And so
in the market.
Yeah. And so basically they made the assumption that, it was quoted at $1 at the beginning of the year and it was quoted at $10 at the end of the year. Wow, that's a great thing. what they fail to remember, because I don't mean to be an asshole here. They are academics. They might not understand, as a practitioner does. Well, there's this thing called a bid-ask spread.
Yeah,
and remember the old joke about the guy who finds the tiny company and he calls his broker and he goes, I want you to buy, $10,000 worth of the stock. And the broker's like, whoa, that's and he goes, just do it. Hangs up. And he looks at it up online the next day, and it's up 25%. He's like, I am on to something here. Continually calling the broker, buying more and more and more. And the broker's like, please, you got under. And he keeps cutting him off. And anyway, he finally looks at it up online. It looks like he's tripled his money in a short period of time. And he calls the broker and he says, sell. And the broker goes, to whom?
Right.
he was the only buyer. And so that was the artifact in the data that they didn't understand, right? That there is value in microcaps. But I think the reason behind that is very different than just their size. The size obviously is a very important aspect, but the secondary and tertiary reasons are microcap stocks have virtually no coverage by any analyst. And, in our microcap at OSAM, something like half of them had no analyst coverage at all, sort of like a quant's dreamland, right? And the second thing is that because there's no coverage, there's lots of inefficiencies down in that market. But the other part is the market itself, the universe itself of microcap companies is basically dog shit. What you've got to be able to do is find the diamonds in the rough. And it gets a lot easier, especially for a quant, if nobody else is looking, to find those down there. But we did find that the really big idea of the small cap effect was really an illusion, and published that in the most recent edition of What Works.
Was a substantial part of it? Did it happen in the month of January?
I didn't break it down on looking at it on the month to month, but yeah, I've read some other practitioners' research that said January had a big tell as well. What do you think, though? Did you follow all of the academic finance papers?
I did for a while, and absolutely. And in the following French, I go to the data library a lot, so I got into that. But it's interesting how once you become a practitioner, so much of that really goes out the window. It really is. It is two different worlds. By the way, I don't know if you saw this was recently in Bloomberg, talking about the controversy within the pharma and French data. Did you follow any of this?
I have not seen that. I put in my book because I thought it was a really important paper. Was by a guy by the name of Macquarie, and he calls the myth of 1926, and which he kind of takes apart the CRISP data set. That's the Center for Security Research Price at the University of Chicago. And basically he shows in his work that the CRISP data set, which I've used, by the way, so full disclosure, in the book, I have several things that are tested on CRISP data. But since it doesn't have fundamental data, we're only able to really test things like momentum and caps and things like that. But tell me about the French pharma controversy you're mentioning.
Yeah, so this is all secondhand, but it's for people to know, this data library is a hugely important resource for finance academics and professionals. And there was an article or a paper published questioning about how this data was used, and the data would actually change depending on when you accessed it. So it was not, if you just thought this was one continuous model, no, it wasn't like that at all. Now, Pharma and French, they had an explanation. They came out with a paper that addressed this. You might say that there was perhaps no intention of being misleading. And some of the improvements they had to the data were not necessarily in their advantage, maybe showing that the value premium was not as strong as they had said. I think that was for small cap. But I guess there was some controversy in that world. Cliff Asness, I'm a huge fan of, love following up. He said that this was not that important, the criticisms that they were making. Without any other person to, I'll take what Cliff has to say as true. I'll assume that his position is right. But I know that was recently Bloomberg wrote about that, and it was specifically about this data, where I guess Fromm and French, they had their reasons to do that. Maybe they didn't explain it or as transparent as they could have been. That's as I understand the issue.
Well, yeah, in my new life, I am not as wired in and glued into all of the controversies in quantitative finance. But I know from writing the original version of What Works on Wall Street, even the gold standard data set, CompuStat, which includes all research companies, really important, right? So research, if it's in the research database, the company went out of business, got bought, went bankrupt, etc. And a lot of the original quant research, similar to my own, didn't have the research data. And so it looked like, wow, this is amazing. Look at all the alpha you can get. So you really have to have all of the companies that used to be available but no longer were, to avoid the upward bias. But we also, in some of the original research, the people were assuming that they would know a number when it was printed in the data set, right? So they didn't time lag for the fact that you didn't know that. I tried to address all of that with What Works on Wall Street, and then we did do an example of saying, okay, so here is, and let's just pick something simple. Here's buying the 50 stocks with the lowest PE ratios, right? And doing it annually. And we're going to do it just on the active data set, right? And so here are the results for that. Then when you add the research database in, the results go way down, right? Because low PE, low price to book is often a proxy for risk of bankruptcy. And then when you time lag it so that you only know the number when you actually would have known it in real time, goes down again. And so I'm a big believer in always pushing the envelope, because what you really want is you want an honest assessment of what a person could expect using that particular type strategy. So we tried to be very, very careful with all of the things. I was able to sort of stand on the shoulders of giants. I always joke that if Ben Graham had a data set like I was able to get and computers, I would have never been able to write What Works on Wall Street because Ben Graham would have written it. But what was the spark? Because I want you to walk us through how you decide to put a name on your buy list to bring them up to the big show from the miners. Give us a sense for what that process is.
I like to look for a consistency in operations. So a company that has steadily rising sales and earnings, steadily rising dividends. It doesn't have to be, but that's you want to see the trend that is rising in business. Acceptable balance sheet. I hate to use the phrase a strong moat, but that certainly does play a big role, that a company has a well-defined market niche. There's somebody that they serve their market and they do it very well. That they have some sort of enduring competitive advantage that always plays a good role. Think of a company like Moody's, wonderful company. FICO. I mean, when a company, when the particular name becomes the adjective, when people talk about their FICO scores, they don't use any other companies, and they're probably unaware that it is a company, but that's so dominant in their field. I think of a company like Stryker, which is on the buy list. We're all slowly going bionic. Companies like that have a well-defined market niche, are well-run. I like companies that I don't know I know I'm not going to get headaches from. I know Aflac is a superbly well run, and I trust the management. A lot of times there's a controversy about looking at the numbers. Are they the pro forma earnings? Well, there's a reason why we have pro forma earnings, and for good companies, I trust what they have to say. For sketchy companies, I don't. So it's always nice to have companies that I consider high quality, and if I see any problem that they have, I know that's a reason why I may not want to hold them any longer. So just I would say high quality companies, companies that I believe in, I have a lot of faith in. I like the transparency from companies. I like when companies offer financial guidance for the coming year. You don't have to do that. Sometimes they're very, unsure about that, and I certainly understand. But I like when the company says, we see we're going to earn $5 per share next year. It adds a layer of comfort to what they're doing. So it's in the broad outline that I look for high quality companies, and that's sort of what everything that goes into it.
And many changes over the years, or just sticking to your knitting? Have you found anything like is there a new factor or thing to look at that you weren't looking at originally when you started in 2006 that you're looking at now that you really believe in?
Nothing like major. I probably will. I know there's some research on companies that have a high short interest, and if I see a real red flag on that, that will. I don't think I did that years ago, but I'll at least consider that nowadays. But outside of that, no, it's pretty much the same thing.
And, the other thing that you and I really align on is ultimately, if you're a hyperbolic discounter and only looking at today, right, you're probably going to get sucked into a more trading oriented aspect. And in my mind, like, markets are the greatest gift to people who want to save for the very, very long term, right? And I know that you feel the same. You're really good on Perma-Bears. I love the way you taunt them, and and do you think it's just because of pessimism sounds smart?
Oh, absolutely. No, it sounds wise. It sounds that this sort of cynicism. I hate the cynicism masquerading as wisdom. That's what I really ticks me off. And there's always something that to become a bear. There's always things you can look at and saying things that are going to always fall apart. My friend Gary Alexander talks about the apocalypse. They're not happy unless the world is about to blow up. And really, what the market's onto is just be the belief in a better tomorrow, that things will gradually get better and improve. And that has been the winning way. I mean, we've been doing it in this country for 230 years, and it's not, it sounds like it's the easier way, and perhaps it is the easier way. But I found, I think there's no question that even look at the disasters we've had, the financial disaster. We've come through them all, and nothing was like the Great Depression or the Civil War. My goodness, we don't face anything like that, But it's the gloom and doom crowd I find unimpressive.
Yeah, and I used to bang my head against the wall continually, trying to make exactly the point you just made. I'm kind of like, hey, just in my career, we had the great crash of 1987. We had the savings and loan scandal, and you can fill in and people. It's so funny to me because I was usually pretty good at reframing things for people, but in the here and now, if the market was like plunging, they just seem to throw all of those things out the window. And then I bet you've heard this a million times too. Look at me, dead serious. But Jim, you don't understand. It's different this time. And I think that, I like Warren Buffett will never short the United States of America because like we have it is you just enumerated. We had a civil war for God's sake, and and then fought in two world wars and suffered through a Great Depression and market crashes. And here we are. And the person who just invested for the longer term ended up doing significantly better. Now, even the people who always respond, now do Japan. Well, guess what? The Nikkei finally regained. Now, I will admit that you've got to have had a really long-term perspective to have hung in there with the Nikkei. Do you do any non-U.S. investing, or is yours entirely in the U.S.?
I place no specific target on that. So I did have some. I don't believe I have any right now.
Yeah. And any chance for any of the so-called story stocks, and I don't mean the ones that are just story, but stocks like that everyone loves to say that they own, like NVIDIA or those types of names. Do you look at those, or is your process wanting to stick with the more boring but dependable?
Generally, probably because of me, I like more boring names, and a lot of the things I just don't have the expertise. I had Microsoft for a number of years. I sold it too early. I should have held on. So I felt comfortable with that. I have a weakness for smaller industrial companies with pretty basic operations. That's sort of what I often lean towards. And I'll go anywhere I can find a bargain.
Have you found anything that surprised you when you went into actively manage an ETF that either bugged you or you were like, what the hell? I didn't have this problem when I was just doing the buy list.
Absolutely. And the thing is, like so many people, I said, oh, Wall Street, they have all these terrible fees, and the fees are too high. The fees need to, come down. And Vanguard, you can buy, and they charge you 4 basis points. That's how it should be done. Well, I was never on the other side, and I remember once I was with my business partner, we were going through all the fees. The exchange fees, the filing fees, the lawyer fees, the custodial fees. And so the companies weren't just being greedy, but there's a lot goes into it. And Vanguard has $1 trillion. So of course they can charge, 4 basis points, and they can be fine with that. And so I didn't realize how difficult that was. It was much harder than it really was an education, understanding that there's a lot that goes into it. So if people want a prospectus from me, I have one. We can send you one. But that's a lot of legalese, a lot of lawyers look over to. I don't know anything about that type of language. You don't certainly know what I'm talking about. So so my complaint about the fees, I real world came into contact with that.
Any plans for a second ETF, or are you just happy with what you've got now?
For now, I'm happy with what I have now. My friends always joke. Josh Brown says he wants to open up a short CWS ETF, but so I have to take the teasing. Can I mention a quick aside that in the 1990s, I had a microcap newsletter. And not only did I have one, but I was featured in an article by Jim Glassman in the Washington Post. And in that article, I think it was in August 1997, do you know who else was written about in that article?
I think I have a vague memory, but lay it on me.
That was and your book, What Works on Wall Street, which probably was maybe still in its first printing. So that was 26 and a half years ago that that we were in the Post. Back then, reading the Jim Glassman article was a big thing, that you would actually buy paper and read the article. So
no kidding. Why did you get rid of the microcap newsletter?
I thought it would be a great niche to have the only person who talks about microcaps. I ran up. The reason why I started was I looked at the academic data, as you'd mentioned. I said, "Wow, this has tremendous results." And then I realized once actually having a listing what I liked in a newsletter, it's much harder to do than I thought. And I think that microcap premium is not quite what it appears to be. And I just couldn't sell as many newsletters as I could. I was literally working in my my basement trying to get these newsletters. And I mean, I sold a couple hundred copies, but it just wasn't very profitable for me. So I shut it down.
Very entrepreneurial. And what do you think's next? We mentioned how blogging has now been overtaken by the Substacks of the world. What do you think about what do you think the next chapter is for people offering market intelligence like you do through your newsletter?
Oh yeah, I think Substack is still going to keep on growing, and I think we're going to also see journalists going over to Substack. And I wouldn't be surprised if we see companies and investment banks having some sort of model that way, that they're trying to monetize their own their own people, their own research staff. What really, I think the larger theme is that the gatekeepers no longer play the role that they used to be. So, unless you were in the Washington Post or the New York Times, Wall Street Journal, or Barron's, you just didn't have a voice. I mean, there were some, fun newsletters that were out there that people read, but that sort of, just now you could just set up a Substack and write down your thoughts. If people like it and you keep at it, you can get a nice audience. And I think that will continue to grow. It'll be interesting to see as more journalists merge over into that sphere. Maybe there will be other competitors to Substack. I don't know.
So the challenge there is, like you mentioned moats earlier when you're talking about your criteria for buying or putting a name on your list. Like you've got an incredible moat, really. You have a record going back to 2006. What do you think will be some of the strategies for the young guns who want to come on and say, "Hey, Eddy, time for you to move on. We've got this killer app over here." Is there one?
Well, I mean, it's sort of like what's the invention that will come along that I don't know about? It's hard to answer, but I just don't know. I suspect that I'd be curious to see if big data can actually get to an easily digestible and usable product or realm of products. That I think would be very interesting if it involves AI or just huge amounts of data crunching that we're not able to do yet. Can that not just be sort of a neat toy, but actually think of like automobiles. They start off as these kind of toys, and then Henry Ford said, "Well, no, this is something we can build one for the masses." That's what I would be interesting to see how that space evolves.
Yeah, that's one of the things that we are looking at O'Shaughnessy Ventures. I sort of thought that traditional quant had kind of reached the end of the road because we were all using the same data set primarily. And that's when I started getting very intrigued in machine learning and those types of things. Jury's still out, but we are seeing a ton of really interesting stuff in the AI and machine learning part of the universe. I actually had a couple of portfolio managers who are pioneers in that space who are using AI, and the results, they're short in nature. I think one of the longest track records I've seen for an explicit fund using explicitly AI, because of course there's Renaissance technologies and a lot of very longer term track records that are using bits and pieces. But yeah, I'm very, very intrigued by that area of the market going forward. So, what we do with our
I
guests,
like the exploration of it. So we cut you off, but I really enjoy just digging in and finding something that nobody else knows about. I really enjoy that sort of almost like private investigator level. I think it's just thrilling. It's the oldest way, and I still think it's a lot of fun. And some people say, oh, it's not like how Warren Buffett was in 1958 because there's all these stock screeners. There are plenty of opportunities. Maybe you can't build a $600 billion fund off that, but I think there are plenty of ways you can find out. On my buy list, we have Miller Industries. It's a tow truck company in Tennessee. Nobody follows it, and it was such an obvious bargain for us. We held on, and it's done superbly well. So that's that level of the market. That's what I'm interested in. And that's what I just find it's a thrilling mental exercise because you're going against the masses and everyone's telling you you're wrong. And you are planting a flag and saying, no, I'm right. And I'm going to put my money behind it, or the money of our investors.
that was always one of the things that drew me towards Wall Street. It was just such a wonderful puzzle that I when I was getting interested in it, of course, that was not too shortly thereafter the Business Week death of equities. And all of my contemporaries, if you remember, like when I was 22 in 1982, beginning of the biggest bull market in U.S. history, like my friends were like, what are you, insane? You're interested in the stock market? How old are you, man? Are you like 70? Like right. The stock market, it's all hard assets. It's all commodities and real estate. And again, it's just gold, exactly. And it's just a wonderful story of how the short term can blind us to the longer term opportunities of investing in equities. Well, it has been absolutely a tremendous pleasure on my part to hook up with my old Wall Street buddy, who is very, very funny. And one of the things that we do on the podcast is we make you the emperor of the world, but you got to play by a couple of rules. You can't kill anyone, and you can't put anyone in a re-education camp. But what you can do, we're going to hand you a magical microphone, and you can say two things into it, and the entire population of the earth is going to wake up whenever their next morning is, and they're going to think to themselves, I just had two of the greatest ideas, and unlike other times in the past, I'm going to actually act on both of these ideas. What are you going to incept to the world's population, Eddy?
Well, first, I'm going to get rid of the DH rule. I don't know. I mean, after that takes care of so many problems. I don't know what else. I mean, can it be peace and love for the whole world? Am I allowed to say that?
You are allowed. This is an anything goes kind of podcast, Eddy. So you can say whatever you want.
I get rid of any tax on share buybacks. That's just stupid.
Now that's music to my ears. So where can people find you, Eddy, other than Twitter, where you are the bon vivant of FinTwit?
Well, I have my Substack, so that's CWS, the Substack. So that's two newsletters each week. One is free and one is paid. And then the ETF, so it's the Advisor Shares Focus Equity ETF, and the ticker symbol is CWS. There's a webpage at Advisor Shares. All the information about the fund is on there, all the performance statistics and whatnot. You can see there. And as like you said, I'm on Twitter. I love to interact with people there. So those are the main ways that people can get in touch with me.
Terrific. Well, Eddy, this has been great. You are one of the OGs, and delighted that you took the time to chat with me today.
Thank you.
All right. Cheers. Bye.